Hello and welcome to Market Domination Overtime. Investors on edge ahead of a big week of economic data. Jared Blickery has a look at the closing action on Wall Street. Jared.
Yeah, thank you. Big week, but we're not seeing it in the majors just yet. So the Dow, kind of a lot of nothing today. You can see it's down to a whopping 41 points, or 9/100ths, of 1%. NASDAQ, though, I will say the tech sector saw some selling today. We saw some rotation in other sectors. We'll look at that in a minute, but it did finish close to the lows, which were actually from the early morning there. So NASDAQ down about 0.5%, S&P 500 down just nominally. And as I like to point out, the S&P 500 equal weighted index, that was positive. Not a lot, but it shows you that there is something to be said for the market coming together where every stock gets one vote and being able to propel that index to a nominal new high. Now let's take a look at the sector action. As I said, tech was in last place today, followed by energy off 1% and 0.2% respectively. Materials also down just slightly. Healthcare, number one sector today, also the number one sector of the quarter, the fourth quarter. Second is utilities. That was up about 0.9%. Consumer discretionary, then real estate, staples, industrials. That fills out the top row. So broadly speaking, we saw a little bit of defensiveness, but also something to be said for some cyclicals and defensive. Maybe it's just some random Monday action in the middle of December here as we're waiting for those final big reports of the year. So here's the NASDAQ 100. Seeing what's a standout here is we're seeing some selling in Broadcom. That's down another 0.5% following the Friday earnings rout that we saw there. But Tesla up 3.5% right next door to it. Nvidia also up under 1%. Meta's just some a little bit of green there. And other than that, kind of a smattering of red and green. And I'm going to move on to the Dow, where we saw some outsized upside action in the staples. Procter & Gamble, one of the worst companies in the Dow this year, was up 1.6% today. J&J up over 1%. Amgen, Honeywell, all of those up more than 1%. Meanwhile, Salesforce down about 3%. So we'll have to see what comes of that. But I will leave us off on the transports. More red and green stories here. Delta Airlines up 2%. And let's take a look at the year to date real quick. That is a high of the year for Delta Airlines, up 17% this year. Also seeing some strength in Southwest. That's up 1.3%. American, and the big sore spot here, though, is Uber, the biggest sector, a biggest stock in the transportation index. That was down about 3.84%. Josh?
All right, thank you, Jared. Well, join me now. We got Melissa Brown, SimCorp Managing Director of Investment Decision Research. Melissa, great to see you. Let's start a big picture here. Melissa, you know, the market has been dominated by two themes, AI and Fed rate cuts. Let's start there with AI trend. You say creeping doubt. It sounds like about AI stretched valuations. Walk me through that.
Well, you know, the AI story is clearly a good story, but stock prices reflect that, if not more. And I think the growth would have to be phenomenally high in order to justify these valuation levels.
So does that mean, what are the implications of that? Does that mean, okay, I should expect to see a shift then away from AI names, away from AI leadership going forward?
Well, typically you wouldn't, just because they're expensive doesn't mean that investors start to flee them. But what it does mean is when investors do start to pull out, when they have some other reason that's driving them out, the drop tends to be bigger. So because they've got farther to fall. So, you know, we're starting to see that creeping doubt about, you know, at least about the near term for some of these stocks. And so, you know, there is some concern that they could fall, not just fall, but fall a lot.
It's interesting the dispersion in the names. Like it's almost like it's not really the Mag 7 anymore. If you just look, it's almost like it's like the Mag 3 or 4. I mean, does it get a lot tougher for investors in 26?
I think for many reasons it gets a lot tougher.
What are some of the other reasons it gets tougher?
Well, I mean, other reasons. We've had 3 up years, assuming that between now and the end of the year we, you know, don't fall too much. So 3 up years in the market tends to be followed by down years. It's or at least returns that are much less positive. So that's one reason, Xing out anything about the Fed or the data that's going to come out or what's happening with unemployment or inflation or anything else. And so I think we're facing some headwinds. We've had some good returns, but it's been on relatively low volume recently. Another concern we have is that volatility has been quite low, unexpectedly low, and we're concerned that gives investors a false sense of security that they can just come in today and not worry about their portfolio falling tomorrow. But does that also induce them to take on more risk?
I get bulls who sit in that very seat, Melissa. They take the other side of the trade and they'll say, bottom line, I'm going into 2026. I got monetary stimulus. I've got fiscal stimulus on the way. The AI CapEx trend, just judging by what big tech just told me on those earnings calls, full steam ahead. What's not to like? What's your response to that?
Well, otherwise we wouldn't have a market, is my basic response. And I think, a lot of those things are very true. The question is, how much do market valuations, market's up, 17, 18% this year? It reflects a lot of that good news already. Certainly the monetary stimulus has been built into stock prices. Fiscal stimulus, I think, is a little more uncertain. And then, as we said, AI stocks, their earnings may be there, but the valuations reflect that already.
Your point, we priced in a lot of good news.
Yeah.
Let me get your take on the Fed. How many cuts in 26, Melissa? What's the base case?
That's a really tough one. I don't know. I think we're looking at potentially a stagflationary environment, and I think that makes the job, not that it's ever easy for the Fed, but I think that makes the job.
You're worried about
tougher.
inflation staying sticky.
Yeah. It's at 3% now.
Yep.
We haven't really seen it come down. I guess we'll see some data releases later this week, but and 3% inflation, is not 8% inflation. It's not awful, but it's above the Fed's target. And, even with Powell's comments, he seemed to suggest that it's not a foregone conclusion that they'll continue to cut next
What
year.
did you make, just speak of inflation, maybe you have thought, Federal Reserve Governor Stephen Myron was speaking today, delivered a speech. Now, he would like to see the Fed cutting harder. What was interesting is he does not share these concerns about inflation. Here's what he said, just get your take. He said, the lack of a clear downward forecast for core goods prices might suggest keeping interest rates elevated. But he goes on to say, I expect more than enough disinflation from housing services to counterbalance that possibility. What do you say to Dr. Myron?
Well, I hate to argue with a Fed
Harvard-trained economist.
But I think, housing, we could see disinflation from housing, but people don't go out and buy houses every day. They go out and they buy gas and they buy groceries and they buy the things that are really impacting them. That are possibly subject to more inflationary forces, certainly subject to the impact of tariffs. And so when we look at the big picture, we may see that inflation is not as high as it might be. But I think for the average person who is buying goods, they may still be feeling that inflationary impact.
Listen, finally, I have to get your take quickly. We're all waiting for who's going to be the next Fed head. The headlines keep dropping, reports that maybe Hassett isn't the front runner we thought he was. Do you think the market has a preference? Hassett, Warsh, Waller, Bessent? Do you think there's a preference there?
I think it depends on which part of the market you're talking about.
Stocks and bonds may react differently.
Yes, exactly. And, I think the bond market is probably more focused on maybe a little bit more restraint. The stock market, probably likes the easing. But my concern is if the Fed is easing too much, it's going to re-trigger inflation. And and again, we're back to that, they're easing because the economy is not great, but they're triggering inflation.
We'll have to get you and Dr. Myron on it, both here for a good debate. Melissa, always great to see you. Appreciate it.
You too.
Coming up, Ford making changes to its EV production. We have the details coming up next. Melissa, always great to see you. Ford is out with an update on its approach to driving profitable growth, including several shifts in its EV investments. And Yahoo Finance's Praz Smranian joining me here with more Ford making news. Give us the headlines, Praz.
There's a lot to go over here. So the main picture here, main big picture thing is a pivot, more of a pivot towards gas-powered vehicles, right? So Ford said today that they're going to be making more trucks, more gas-powered trucks, more hybrids, and some EVs too, by converting some of their EV plants that exist right now into truck plants. The Lightning EV pickup is done. It's officially canceled. We talked about this before, that there was writing on the wall that it was going to go away. It was just too expensive. It lose too much money in that vehicle. So that's going to go away in its current form. And forward to the next generation Lightning pickup, whenever that comes, would be an EREV, which is a range extended EV, meaning it's an EV, but it has a gas engine inside, and that gas engine powers a battery that then in the car gets going. So they see that's the kind of truck they want. 700-mile range is what that truck would have. A lot of power to tow. That's what their Super Duty buyers or truck buyers want. They want these types of capabilities, so they're going to do that, among other things. So then their new universal EV platform that'll be making smaller EVs. That's what they think people want. More broader range of customers. They can make them profitably, so they say. And then, interestingly, battery storage business. So Ford is going to convert some of their battery plants that they had with a joint venture with South Korea's SK On. They're now acquiring those battery plants. They're going to make battery storage for grid scale operators, data centers, they mentioned, people that need a lot of battery storage. They're going to get into that business of making the batteries. So they have the technology, they have the cells, they're going to make different cells. They're using CATL technology for some of these. And then finally, there's going to be some charges there, and this is the big one here. We're going to report a $19.5 billion charge in special items, with the majority recognized in the fourth quarter of $12.5 billion, and the rest in 2026 and 2027. So that's a big hit, but it won't hit the adjusted, right? That'll still be fine. Inclusive of those charges, right? $5.5 billion in cash, sorry for that. $8 billion in a write-down of EV assets, right? And $6 billion related to restructuring, i.e. changing some of these battery plants to grid scale type battery plants. So a lot going on there. I missed some stuff here. It's a lot.
It's a lot.
Yeah.
Let me ask you this. I mean, so Ford makes this pivot. How much of this is a surprise in your opinion, Praz?
You know, the Lightning being canceled is not necessarily a surprise. We saw that writing on the wall, reports talking about that. It was just it's a great vehicle, but it's just too expensive. I think the sheer number here, to me, is surprising. Another $8 billion in real EV-related charges. That's on top of whatever else they've been doing over the past couple of years. So that's kind of a big deal. But you see the market. You see the 2% move. It seems like the market's happy with it. Rip the Band-Aid off, I guess, moment. They see that the charges were necessary, and they're giving Jim Farley another kind of second shot here, because he really went all in on EVs, and now it's sort of the Ford and the board are paying the price. But at the time, in 2022, it was the right move. Many thought.
All right, Praz, thank you. Appreciate it. For more now, let's bring in Garrett Nelson, equity analyst and senior VP at CFRA Research. Garrett, your timing is always impeccable. You just had these headlines drop, my friend. Ford taking a $19.5 billion charge to write down EV investments, at least initially here. I see the stock popping about 1.5% here in the after hours. What is your immediate response or reaction to that news, Garrett?
Sure. Thanks for having me. I think the only thing that's really surprising is the magnitude. The 19.5 billion is larger than we would expect. I think it was said 8 billion of that was related to EVs. I don't think it's a surprise. I think most investors have anticipated this. So I do agree with the takeaway. It's sort of a rip the Band-Aid off moment. We saw General Motors take a charge of 1.6 billion back in October related to their EV assets, and really, this became inevitable as soon as the federal EV tax credit went away at the end of September. EV companies looking at taking impairment charges related to their EV assets, and overall, I think what we've seen in the market is all positive for Ford. Their U.S. vehicle lineup is entirely comprised of trucks and SUVs at this point, aside from the Ford Mustang. So that's the only model they still produce that's not a truck or SUV. So they benefit from lower oil and gas prices and declining interest rates. So they're really the big winner. And they didn't make as much of a bet on EVs as General Motors did. They took more of a balanced approach between EV, hybrid, and internal combustion engine vehicle. And Ford has done very well with their hybrids. So there's a lot of reason for optimism optimism when looking at some of the hybrid models they have.
So reasons for optimism, but Garrett, you used to have a hold on this name, correct? Why are you still on the sidelines, Garrett?
Yeah, the stock's had a big rally in recent months, and we think the risk reward is pretty balanced here. That said, our 12-month price target is $15. It does imply some upside here. You have a nice dividend yield for the stock. We just like some other names better. We like GM better here. We think they have a more favorable risk reward. And we like a lot of the things that they've been doing and the fact they've been picking up so much market share from competitors in the U.S. over the last few years.
I want to switch gears here, Garrett. While we have you, Tesla shares, you saw this, closing near a record high. It's after the new robo-taxi test without a safety monitor commenced in Austin. Garrett, you looked at those headlines. What did you think of them? From an investor perspective, Garrett, was that, how material was that? Was it an incremental step or no? Was it a bigger deal with possible financial implications next year?
We think more of an incremental step. We are a little skeptical of how quickly Tesla can really expand to other markets. There's still a lot of questions, and more importantly, there's significant liability still associated with their full self-driving. And so we think if you look back several months ago, as far as how quickly Musk was saying they could expand to other markets, it hasn't exactly panned out, over the last 6 months or so that they've been able to grow to all these markets. This has really been a roller coaster year for the stock, but the stock is basically after hitting a trough, a big sell-off in the first quarter, hitting a bottom in April. It has rallied, and it's basically where it was a year ago. Over time, I think volatility has really been the rule, not the exception for the stock. And it's another name where we're just not too enthusiastic about the risk reward here after this big rally since April.
Yeah, you actually have a sell on this name, Garrett. How come?
Yeah, you look at where the stock's trading here. On our 2027 estimate, which is below consensus, about 50 cents below consensus, we have it trading north of 175 times our 2027 EPS estimate, which is a full valuation in our view. If you look back over the last 5 years, Tesla has traded at a 4 PE multiple of about 112 times. So it's well above that. Looking at consensus numbers for 26 and 27, we think they're too high still. And we haven't seen the worst of the drop-off in their EV sales. In a couple weeks, when they report fourth quarter sales, we will see that fourth quarter being the first full quarter in which the U.S. market was not subsidized in terms of any sort of EV tax credit. So Tesla's had a big drop in their domestic sales over the last couple months, and I think that will become more apparent in early January.
So Gary, we just showed the stock chart there. I mean, it's the move off that April low. It's up more than 100% since early April. You chalk that up then, Garrett, to what? That's fundamentals, or no? That's sentiment. That's just a lot of folks who believe in Musk and this grand AI vision.
Well, it started with when Musk announced he was leaving Doge. So that was really the catalyst. That's when it bottomed. And I think it's more sentiment driven. We do like the fact that Tesla is in sort of the industries of the future with what they're doing in AI, in robotics, in energy storage, autonomous driving. So I think investors continue to take a sort of 5 to 10 to 15 year view of the story, and they're focused on what the earnings power looks like, say a decade or so down the road. Really giving Tesla a pass on the very obvious near-term headwinds. If you look at the company's earnings in the first 3 quarters of this year, they were down 31% year over year. So it's that disconnect between the underlying near-term earnings and what the stock price has done, which caused us to go to a sell in September.
Garrett, always great to see you. Thanks for your time.
Thank you.
Time now for to watch Tuesday, December 16th. Going to start off on the labor market. Another crucial piece of economic data coming out on Tuesday with the November jobs report. The report will have some delayed data from October due to the government shutdown. It will include payroll data, but not unemployment data. Economists forecasting the U.S. economy to add 50,000 jobs in Tuesday's report, while unemployment comes in at 4.5% and hourly wages rise by 0.3% on a month-over-month basis. The new report providing a key piece of economic data as the Fed plans its monetary policy path going into 2026. Taking a look at the consumer as well, we're going to be getting U.S. retail sales for October on Tuesday. Headline retail sales expected to slow from 0.2% to 0.1% on a month-over-month basis, while core retail sales, that's excluding autos and gas, is expected to jump from 0.1% to 0.4%, signaling that the underlying consumer is stronger than the headline sales number suggests. And finally, some insight into the housing market coming out on Tuesday as well with Lennar earnings, the home builder reporting results for the fourth quarter after the markets close. Analysts expecting margins to weigh on the company's Q4 report. Lennar using heavy sales incentives to keep buyers interested, which could put pressure on the company's profits. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.